Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, thanks as always for having me.
Tim, are we watching a bursting of a giant bubble, or is just a buy the dip correction?
Jim, I think, as I said in the last interview, I think, it broke on February the 24th. The structure broke, and I think it's the unwinding of the bubble that we've talked about. You know, as we continued to watch the bubble ramp up, you know, I explained that structure was key and that there was a process underway. As the bubble ramped up, we watched, you know, I say we, my subscribers and I mean, we saw setup after setup, and I think you and I talked about it on some of the interviews, how seemingly the market would be at a juncture where it would be on the edge, and we'd see the tweet, we'd see the news, we'd see the fluffed report, we'd see something, and it would just continue to blow the bubble even higher and higher, or larger and larger, I should say, tighter and tighter. And what we have seen is no doubt in my mind the largest bubble in history, and it's been created via such manipulation and monetary policy. It's not been on the basis of a sound underlying economy, and we've talked about, I've shown that in great detail in the letter, and even before the election. President Trump talked about that, and that it was the weakest recovery since the Great Depression, and that's factual. We talked about here how the mainstream averages in the U.S., the S&P, and the Dow Jones Industrial Average was cover for the underlying economic conditions, and even cover for some of the underlying leading stocks and other averages, such as the American Stock Exchange and the value line. There were some major non-confirmations there that mean something. Those are signs. It's part of the process. We talked about the weakening of commodities, and that was part of the process, and lower interest rates, and how that was the inversion of the yield curve. I remember specifically talking about back sometime between August and January, we went through this period with the interest rates, and when I said that it was a period of tranquility, where there was this, this middle portion. It was a period of just, kind of like the calm before the storm, I think is what you said, where interest rates kind of paused before the next leg down. We talked about that. It was part of the process. It's like cogs in the wheel. And as long and grueling as the process was, because it was manipulated, it kept pushing and pushing and pushing and extending it. But all the while, those little wheels, those little cogs, they would set up piece by piece by piece. But because of the size of this thing, it took forever to set up. And we watched that. We talked about that. All these little things were pieces, parts of that. And, I saw it really starting to set up with the structure. I said that, but however, in spite of all that, extension of the bubble and all these little pieces taking hold underneath the surface, structure of the market was key. And back in January, it's documented, it's in the letters and updates. I saw the structure starting to set up, and I gave specifics. I said, okay, here's what we're watching for, here's what's developing, and if this happens, this is what it means. And on February 24th, it broke. And so I think things have changed. I do think this is the unwinding of the bubble, the largest bubble, like I said, in history that was based on not a sound underlying economy, but monetary policy and manipulation. I think this is a financial crisis, or it's going to evolve into a financial crisis. It'll prove to be a financial crisis in association with the unwinding of that bubble. And I think we are now moving into the liquidation phase of that. Now, that said, there will be bounces along the way. And I think there's if we didn't see a low today, I think there's a low within, I have some short-term cycle lows due momentarily, within, we're real close. And, if not this week, next. But I think that's counter trend. And based on the structure I see, I think it's broken, and I don't think this is by the dip like people think.
We'll have more with Tim Cyclesman Wood right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, when we first started talking about the dangers of this bubble, people were saying, oh, no, don't go to cash, don't stand on the sideline, look what you're going to miss. And the market went up 20% from that point. I remember that. But it's lost that 20%. If you'd gone to cash right now, or had gone to cash then, you'd be at the same point or perhaps a little better off, wouldn't you?
Of course, absolutely, and that's the problem with bubbles. That's the nature of it. And look, I admit, I have no shame that when you're dealing with a bubble, and you recognize that it's a bubble at point A in time, it doesn't mean that it's still not a bubble in point B in time. And when it extends to point C and D and E and F in time, it doesn't change that it was a bubble at point A. I mean, like I said, President Trump talked about it being a bubble before the election in 2016. And so the fact that it was extended is, it was beyond comprehension, that it could ever be pushed like it was. But it was what it was. And that's the environment you're in when you're dealing with the bubble. But like I said, all these warning signs were underneath the surface. All this stuff was telling us. I tell people, we talked about it. It didn't register. They didn't understand. They discounted it because this time is different. And this time was not different. The process was different. The duration of going through all that was different. But, so I guess what I'm trying to say is on the one hand, yes, when you're dealing with bubbles like that, they can go on a lot longer than ever imagined. But it was a bubble, and now, the problem is you look at it and you go, well, I can't get out now. And you get a bounce, and then people say, okay, well, it's over. And that's what we're going to hear. And then, you get the next wave down. And like you said, no one, that's the nature of the bubble. Eventually you get into that liquidation phase, which is where I think we're headed or just getting into, and then the whole thing comes unwound and everybody's the loser. Another thing I said about this, and I think you will remember this, I think we talked about it numerous times. I said that the nature of the bubble would be that it was going to seemingly set up out of nowhere. It would be real subtle, and then it would just seem to crack. Well, that's exactly what happened, but we saw the structure piece by piece. I called it like Howard Cosell with a fight. We saw each piece set up and the structure fall in place in the letter. So, no, I think it's broke. I think it's a very how do I say? I guess just nasty situation because, like I said, once we get a bounce, people are going to think, boy, that was ugly, glad it's over. But I don't think this is going to be that sort of environment, and the reason I say that is because of this longer-term structure that appears to be broken, or it is broken, unless somehow they could engineer, and I don't mean to talk out of both sides of my mouth, but like I said before, I've learned never underestimate the Fed, unless they can somehow pull some rabbit out of the hat, which I don't think that's the case because the structure says they can't, then I do think it's broken, and I do think that, any bounce is going to be followed by much weaker prices.
According to Barron's magazine, the Fed plans to offer banks at least $1 trillion in additional short-term cash loans in its largest effort yet to smooth operations in Treasury and money markets. Will $1 trillion stop this from happening, or will we say that was $1 trillion you wasted?
Structure says that that's going to be $1 trillion wasted, that it's not going to work. We may get some sort of like I said, there'll be bounces along the way. We may get some sort of bounce out of it, but it's once it breaks, there should be nothing that can be done. It should run to fruition. And, I tend to think that such efforts are going to, like I said, maybe have some short-term effect, but no. I don't think they can save this. I think it's broken. It needs to unwind.
So for people, of course, who are wondering, well, what should I do if the equity market is collapsing? The question is, how big, how far? I think some of the numbers you provided to us, in the past, you said 50-80% wouldn't be unreasonable.
It would not. And if you look at some indexes and averages, and I'm going to be working on some projections in the next research letter, and as this progresses, I've got some numbers based on some of the cycle counts already that I'll be covering, for some of the shorter term targets. But, the unwinding of the bubble should take us back. I mean, I don't think, as crazy as it sounds, I don't think that an approach of the 2009 lows is unreasonable. And if you look at some indexes and averages and some stocks, I mean, we're well on our way to that. Now, the blue chip stuff, the industrials, I mean, not so much, but I don't think that's unreasonable, particularly if their efforts fail. And really what it comes down to, I think, is how well can they contain it, not can they stop it. Because like I said, the structure's broke, and that suggests that we go lower.
Now, if we take a look back at the 2008 crash, they bailed out banks, they bailed out car firms. Would they have been better off to just let them fail and let the market forces settle things out? And will they try to do the same things this time around?
Back to the 2008 question, yes. In my opinion, I think they would have been better off to just let things wash out. I mean, that's part of the business cycle, and that's part of the problem, and that's why the debt is what it is, and so on and so forth, and part of why we're in the situation we're in today. Will they do it again? I don't know. I don't know. And if they do, will it be effective? I don't know. But, the things they did at the time, it didn't stop the decline into the low. I think that the things they did extended the advance coming out of the low, but they didn't stop the decline into the low. It ran to fruition, and I think that's what we're going to see here.
Does lowering interest rates have any impact on a major bubble bursting like this?
Absolutely not. It did not stop anything in 2000. It didn't stop it in 2008. And we talked about that too. I said that, declining interest rates was a sign of the weak underlying economy, and that it's not stimulus to the market. It's contrary. It's showing that something is wrong with the economy, and people get that wrong. It's a sign of the times, and when we started to see interest rates crack last April, May, I think it was, well, the longer term rates started turning down in November 2018. I don't know if you remember that, but the Fed was talking about raising, and they raised a couple times, and the market checkmated them. The economy couldn't take it, and remember they started using the word dovish. They got dovish in December of 2018. Yes, it was December of 18, wasn't it? And then as rates started down in 2019, we saw the lower rates the market starting to force them to cut. And and we're going to see, obviously, more cuts. I mean, that's what we've been expecting, and that's what we're going to see. And is it going to stop anything? No, absolutely not.
We'll have more with Tim Cyclesman Wood right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, is gold going to be its traditional safe haven, or is it going to take it on the chin?
I think it's going to take it on the chin. We have seen I think the anticipation, the fear, if you will, move or play or aspect of gold with this additional push into the 9-year cycle. Gold has been the holdout. No question about it. Gold and equities. Commodities in general, we knew were going to move lower, and they've actually been among the leaders. And, there's a number of commodity-related indexes and averages and stuff that have led the way and have given me, great comfort in the forecast with commodities. I knew that crude oil should move lower, and it was resilient, but the structure never changed in that it should have moved lower. I knew that it was a counter trend advance. And then finally, we saw the break and crude oil joined the party with the other commodity related indexes and averages, just like they suggested that it should. I have some data, this Journal of Commerce data and so forth, and it always leads the way. And it suggested that crude oil should move lower. And so did the statistics with the cyclical setup. But it took a little while. It was resilient. It took a little while. That said, it did exactly what it was supposed to do in accordance with those statistics in violating its previous 3-year cycle low, which is what we were expecting all along. And I said all that to say this. Gold, while it's been resilient as well, and it first tried to make that 9-year cycle top, a couple of times in the past, and then we had this last push up. There are also relationships and statistics there. It's been resilient as well. I think that we're now in a position where we're going to see the liquidation in gold as well. Yes, the liquidation in gold as well as we move into the broader, let me say it this way, as we move into the broader liquidation phase of this process. So yes, I think gold goes down as well.
With crude, is $20 crude oil possible or likely?
I think it's possible. The thing is, my target was that we violated the previous 3-year cycle low. I'm not looking at a chart now, and I'm speaking blindly, but there is still time in that cycle left. There's still a lot of time in that cycle left before we get to the next low. So I don't have any projections other than that, that initial projection was met. And that happened, I think, when we violated the $41 mark, as I say that from fuzzy memory. And that happened, I think, last Friday. And then, of course, we saw what we saw. Maybe it was last Thursday or Friday. and then we saw what we saw earlier this week. But then, yes, I think ultimately it does grind lower.
Tim, how would you sum up the situation right now?
Somewhere between dire and sad, because I don't think people realize what has happened. And I think that in turn makes it sad, because, you know, I said when the rally out of the 09 low began that the longer the rally lasted, the more dangerous it would become. And what I meant by that was that people would buy into the rally more so, and they would discount the risk associated with that rally. I had no idea how profound that statement was, but it's very much applicable. I had no idea the Fed would go to the lengths that they went. I had no idea that we would see, the greatest bubble in history, and that it would go on as long as it did. And in the process, what that has done is it has trained people. As this thing was breaking, I had people texting me and so forth, and they were, trying to buy stock. They didn't understand. They're trying to buy the dip. Today, I had one of my wife's friends telling me she was talking to people at work, and no concern, none whatsoever. The market does this. Great buying opportunity. I'm having money managers tell me the same thing, that they have clients is wanting to get in the market, wanting to buy more. The greed. They don't understand. And, maybe by some stroke of luck that I'm wrong, and they may be right again, but I don't think so, because the structure is in place that says this is broke. And my point is that this has gone on so long that people have been trained in that greed. They've been trained, buy the dip. There's no fear. And here we are with the unwinding of the largest bubble in history, and nobody sees it.
Tim,
and from that perspective, it's sad, because they're going to lose their asses, if I'm right.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.